and welcome to the IPO show right here on ET Now with me, Ayesha Faridi. Well, given that there are no IPOs coming out this week, we thought why not take a step back and really analyze how is it that you should be going about investing in IPOs? What is it that you need to take cognizance of? What are the precautionary measures? What are the do's and the don'ts to invest into IPOs to begin with, and what kind of research should you really put in at an individual level or via your broker to try and pick out which IPO to subscribe or not? So a lot of questions. Welcome to the IPO show once again, your one-stop destination to know everything about IPOs. And today I'm going to welcome a very special guest who's going to really tell us how to go about investing in IPOs. I have with me Mr. Arun Kejriwal. He's the founder at Kejriwal Research and Investment Services. Arun, so good to have you on the show. We thought that since there are no IPOs this week, why not really try and take time out and really go a little bit deeper into how to go about investing in IPOs. And before anything else, Arun, it all starts with the company filing the DRHP. That's the draft red herring prospectus. Now, well, it may be easy for some of us or a person like you to go through it, or bankers and people who are in the know-how. But for the retail janta out there, it's an intimidating document. How is it that you cut from the riff-raff, and what is it that you should focus on when the company files a DRHP and it's available to you to go through?
Aisha, you asked a very brilliant question, and you also summed it up very nicely, that how does the retail janta actually go through the document? So there used to be a time, roughly say 12 months ago, when it was a very, very laborious document. Now, for the fact that retail investors are a large subscribing public in sheer numbers, so a typical issue would see 15, 20, 25 lakh applications. SEBI has made life easier. You now have a summary of the draft red herring prospectus, or when it becomes the red herring prospectus, which is roughly no more than 6, 7, 8 pages. It gives the entire document in a summary. While it doesn't contain too much, but it at least gives you a start of what the hell the company does. Having read this, it's then for the person who wants to decide whether he's looking just for a listing or he's thinking of making some long-term money by holding on to the share even after listing, or looking at buying the share once the listing pop and all the hoo-ha is over post-listing. Now, he needs to look at the risk factors, because the risk factors contain some startling things which may have gone wrong for the company at some point of time. For example, a company may have filed a document, say a couple of years ago, and not tapped the market. Well, the obvious answer in most cases would be that market conditions deteriorated and we did not go. It could also be that the company did not get the valuation it was looking for and hence decided not to go ahead with the issue. This becomes a material fact for anybody looking to apply for an IPO, that once bitten, twice shy. Will something like this happen again or not? Let's move forward. Having looked at the risk factors, you need to look at a very interesting segment which is known as the business that the company is in. Here, it has to talk what it does. It has to mention what activity it is into. It compares itself with its peers. It also talks about who are the peers in this group, what is the kind of business. It gives you details in a snapshot of what it has done over the last 3 financial years. It talks about some of the concerns that may have happened in this 3 years. Typically, this section is about 10, 12, maybe 15 pages, but it gives you great insight into what a company does. If you still want to ponder more, go into the industry overview.
Right. Arun, you raised a very, very important point. It all starts with what is the purpose of the company's capital raising, as in, the why factor. Why is it that you're choosing the IPO route? Because, while many of the IPOs are there, especially nowadays, all startups, so that that's largely for growth capital. But there are many out there who are old, renowned companies, like a MapMyIndia, for instance, which has been there in existence for the last 25 years. But is now knocking on the doors of the public market to try and raise funds. So, I want you to really delve a little bit deeper into this why factor and how it's very important for investors to really go through into not just what the company does, but why is it that they're raising capital?
Right. So, Ayesha, you brought up an interesting question once again. So there are two primary reasons why a company comes to the primary market. One is to raise growth capital. And if you talk of the new age technology companies, and if I could make a snide remark, to raise money to burn more cash. The second is where companies are well established, doing well for themselves. They want some amount of fundraise to be done to sort of capitalize on all that they have done over the last 20, 25 years, and some amount of money being taken out by the PE investors who have been in the company for some time. So the second part, which is an offer for sale component, and like you mentioned, MapMyIndia or CE Infosystems, as the company is known, was entirely an offer for sale, where there was no fresh capital being raised by the company. And this was some amount of dilution by the promoters, some amount of dilution by the investors in the company. So here the money is not going, there are no objects of the issue for the company, but the objects of the issue are primarily listing gains once the company gets listed, and money being received by the secondary shareholders, that is the promoters and the primary investors. So the object of the issue in such a case is not fundraise, but an exit to existing investors. However, on the second part of your question as to why the fund is being raised in general issues, there could be growth capital, there could be retirement of debt, and there could be general corporate purposes, besides, of course, offer for sale.
Yeah, absolutely. The other thing on the wary factor as well, many a times you also see, Arun, that a broker is trying to pitch an IPO very hard. Now, of course, it all depends on what the company fundamentals are, the growth potential and the valuation that's being put at the table in terms of IPO pricing. But how important is it really to select an IPO that is a very strong underwriter, a big investment firm, and also be skeptical of the fact when a broker is trying to pitch an IPO really hard? I mean, is that an indication that it's not really selling?
It's a double-edged sword question that you've asked. Let's understand what it implicates. It implies that an issue is not doing well, and it is being pitched for by brokers. And by brokers, it necessarily means it does not imply the merchant bankers who are involved in the issue. So there could be vested interest for pitching for such an issue. There could be genuine reasons that the issue has not been understood, and hence it is being marketed aggressively by some brokers. Fact of the matter is that if you are unable to explain what the issue is at the roadshow, the domestic roadshow that is done by the merchant bankers and the company, it's a golden opportunity lost. Then trying to explain your business may be a little too late in the day. It's very, very imperative that you need to market your company properly at this roadshow, which is a big opportunity for you. The only other opportunity that is given to a management to explain his business is in the short television interviews that the management does on various TV channels that are available to him. But nobody necessarily is watching that at the given time that it appears on the show. So you have to sell your issue, your concept, your business at this particular event. Coming to your question, what do you imply when somebody is hard selling? It's very, very obvious. You have to take it with a pinch of salt. You can't just take it at face value. And it necessarily implies that all is not well, and therefore the hard sell is being done.
Okay, Arun, hold on to that thought. I have lots to discuss about how is it that one should go about researching on the company fundamentals, and yes, the big important question, valuation, especially with these new age loss-making startups. How is it that you should be valuing these businesses? Well, we're going to talk about all of that after this very quick break. Welcome back. You're still tuned in to the IPO show, and we're in conversation with Arun Kejriwal. What we're trying to figure out today is how is it that you should be valuing IPOs? How is it that you make up your mind on whether or not to subscribe to an IPO? And how much research should you be really putting into figuring out whether or not an IPO is worth a look or not? Now, Arun, like we were chatting about before the break, the big question is there is so much noise around these new age startup, unicorns, decacons, whichever words you want to, call them and, phrase them at. Most of these companies are loss-making companies. You don't know what kind of growth potential they have. You can only guesstimate. Whichever banker or lead manager or what have you expert out there you speak with, and they always say that you've got to don your hat as a PE investor. You can't talk about the today and tomorrow. What you have to look at is next 5 to 10 years. But the fact of the matter is that the retail janta is there to subscribe to the IPO. There is also this big debate about as to how the maximum juice has already been culled out pre-IPO, and what the retail participants are getting out there in terms of IPO is the last mile froth, if I can use that terminology, of the IPOs out there. So the big question really, how is it that you value these new age companies, and how is it as a retail investor, do you really know whether A valuation or B valuation is good enough for a business which is loss making out there, but perhaps has great brand recall and perhaps is in every Indian home?
So Ayesha, I am from the old school of thought. I am getting on in age. So whatever I learned in school, college, and in the stock market is something that you earn some profit. When you earn profit, there is an EPS. When you have an EPS, you have a PE. Whether that PE is high, low, it's for the market to decide. But when you are loss-making, there is no EPS, there is no PE. Therefore, your PE is infinite. So PE loses relevance. And then you talk of market cap to sales as a revenue of sales. And that comes in at a number of 15 times, 20 times, 25 times. And then they use a new word which confuses investors and the retail janta as GMV, gross merchandise value. And I have heard people confusing this GMV with GMP, which is the grey market premium. And you can understand that the two letters or the two terms are so close to each other that it actually confuses people. Having said that, let's understand what this GMV is. At the end of the day, if you go and buy a product on a platform or a technology company, you actually pay for it, and that is your purchase value. How does it matter what that price at MRP would be and what that company would have got? It's a straightforward formula. It was purchased at X, it has been sold at X minus Y, or it has been sold at X plus Y. That's what the company is earning. Why go into this complex formula? But like I said, all these new age companies are not for growth capital. They are basically to give an exit to the guys who are early investors and who are making not returns, but who are making humongous returns. So today, you, I, and the host of retail investors are actually providing this exit to these PE investors to make money and put in some more money in new age companies and make some more unicorns. We need to have better regulation when such companies come in future, so that PE investors cannot just exit having put in money 1 year, 2 year, 3 years ago and making this kind of returns. I hope that answers your question on how do you look at these new age companies.
It sure does. And I mean, honestly, with all the noise and buzz around these new age IPOs, it just gets very intimidating. I mean, if for us, I'm sure that the retail participants out there must be as intimidated, if not more. But the other thing also, Arun, is the exit factor. What is it that is your purpose of coming to the stock market or investing in a particular IPO? Do you exit at the pop that you have got on most of these IPOs? Are these long-term businesses that you want to sit through? A lot will depend on your purpose of investing, obviously. But the exit factor is also becoming more and more critical right now, because typically what you see is that an IPO does great on the listing day, gives you that pop, and then fizzles out.
So let me take a couple of minutes and break down the participants in an IPO. You have 3 categories of IPOs minus the anchor investor, who is roughly 30% of the entire IPO, who is locked in for 30 days. You have the QIB, you have the HNI, you have the retail. Now, the HNI, by and large, is a first day, first show participant who has borrowed, leveraged his money and applied in the IPO. Very rarely do you see an HNI investor remaining in the company when trading ends on the first day at 3:30 p.m. He's out lock, stock and barrel. The retail investor never sells in a loss. Very rarely does he book profits if he's getting a good amount of profit on day one. He tends to ride it through a couple of days, and only when he sees the price falling does he sell. So on typical listing days, you find the delivery percentage of non-anchor hovering between 60 and 80% of the issue size. Who are these sellers? The entire HNI, a large portion of the QIBs who are making listing gains on account of the grey market premiums, and some amount of retail. There is a big churn that happens. So if you ask, are people investing for the long term? People who have applied in the IPO are not in the game for the long term or even the medium term. People who buy on day one are looking for either further upside or are looking at a medium to long-term stay. So we have 2 different sets of investors, one who get in when the IPO is on and get out on day one, and then you have this new set of investors who join the bandwagon on day of listing. I believe it is this second set of investors who matter for an IPO and whether there is further juice going ahead.
Arun, there are so many more aspects, and we could go on and on discussing about how is it that you should pick out IPOs out there in the market. But for today's episode, we'll wind it up right here, and we'll chat again soon and pick up other aspects of IPO investing. But we sincerely hope that our viewers did learn a lot today. Arun, once again, thank you so much for taking the time out.
Thank you.
Okay, on that note, we're going to wind it up right here in this edition of the IPO show. Thanks very much for watching.